Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action as we wrap up what has certainly been a chaotic week for the regional banks. Taking a look at the market action today, you can see all three of the major averages actually trading to the upside. The Nasdaq leading the way up just about 2.4%. Of course, helped from those better than expected results that we got from Apple yesterday after the bell. The Dow up nearly 600 points.
Yeah, it's certainly looking to end on an upbeat note here with a big number on Wall Street that we've been watching today. That is the April jobs report. The data coming in better than expected. Despite a slowing economy, the U.S. economy added 253,000 jobs last month, and the unemployment rate ticked down to 3.4%.
What has been a wild week for regional banking sector. Let's run you through what just happened. Regulators seized control of First Republic Bank early Monday, making it the third regional bank to fail in less than 2 months. JP Morgan then agreed to buy First Republic. And it's the second largest bank failure in U.S. history. On Wednesday, Fed Chair Jerome Powell tried to reassure skeptical investors, saying in part that the U.S. banking system was, quote, sound and resilient. And the sale of First Republic was, quote, an important step toward drawing a line under the banking stress. But investor jitters did return after PacWest confirmed late Wednesday that it was exploring a range of strategic options, including a sale. That sent shares plunging and triggered another round of selling in regional banks, including Western Alliance, Zions Bancorp, and Comerica. So what's next for the sector? We want to bring in Chris McGratty, who's been watching the action play out all week, the head of U.S. Bank Research for KBW, a Stifel company. Chris, it's great to speak with you again. So we're seeing a rebound today off of some of those very depressed levels. But as we wrap up the week, what's your takeaway? Is the worst behind us?
Yeah, thanks for having me back. We thought this week was going to be fairly boring and quiet. Last week, we obviously saw First Republic close. I would characterize that as an orderly resolution. JP Morgan, the country's most prestigious bank, takes it over. The least costly solution to the FDIC. That's been an obstacle that investors have been flagging for the last 3 or 4 weeks. So we thought going into the week that things were going to turn back to the fundamentals and the fear, and obviously that didn't happen. I think one of the reasons the jitters returned Wednesday with the Fed. I think the market was looking for a hint of rate cuts. We didn't get that. I think there's a timing mismatch there, but certainly a volatile week for the market.
We also got that note from JP Morgan today, which seemed to help boost confidence in the regional banks, the upgraded Western Alliance, Zions Corp, as well as Comerica. I mean, at the end of the day, though, does that really matter? It doesn't seem like these stocks are trading on fundamentals at all anyway.
Right. We're seeing some really solid companies trade well below intrinsic value, below tangible book. Certainly select upgrades, and we've done some ourselves throughout this. That helps. But you need broader just sentiment for the group to improve. All right. You're seeing investors, these long only clients, they're underweight financials. Their view is that this is late cycle. And the typical of the book is to not buy financials. But everything has a price. I think valuations will matter. But again, we got to get back to distancing ourselves from March, moving away from that March 9th and getting back to looking at the real core operations of these banks. And the balance sheets look very good. If you look at the balance sheets and you didn't look at your screens, you would not think that you're in a solvency liquidity issue. You would say there's a margin issue, there's some earnings headwind, but not a solvency.
Chris, then I guess what do you think is the pathway forward specifically for PacWest? Because even though the fundamentals look okay with their deposits, their percentage of deposits insured right around 75%, do you think this bank is going to be okay as a standalone bank?
The company, this was a turnaround story at the start of the year. So this is new management. They came in. They took a pretty aggressive approach to the business and a holistic approach in January. The stock was $25. This was a good plan. The company's had to accelerate the plan given the market stress. But certainly this company has valuable assets on their balance sheet. Now, we're market perform the stock. We're not recommending it. But certainly, the market is placing a real deep discount on their balance sheet. And we don't see the level of losses on this balance sheet compared to some of the others.
Are there any regionals that you're particularly bullish on? I mean, if you are brave enough to get in, even after the kind of sell-off that we saw this week, are there potential opportunities on the back of that?
Yeah, there's always opportunities. We are neutral on the group, so we're being pretty selective. But I would say, I would give it to you like this. New York Community, which is a bank that we've talked about before with you, we upgraded that stock after they did the Signature deal. They bought Signature from the FDIC. They were paid multiple billions of dollars to take it off the FDIC's hand. So they immediately grew tangible book. That's a stock that had a great quarter. The stock was up very, very nicely last week, as recently. And so that's a stock with a 7% yield, trading at book value, and the balance sheet's in great shape. One of the names we've talked a lot about is Western Alliance. That is your deep value play. That's 70% of tangible book, very volatile stock. So those are two. And then in between, we really like East West. East West is a bank in California. It's about 65 billion in assets. They have a tremendous amount of capital. Now, they've been building capital over the last 15 years following the financial crisis. This is a stock that trades just above tangible book. They've got 13% common equity tier 1. They do not have the bond loss problem that others do. And they've been waiting for moments like this to deploy that capital. I don't know if it's in the next 6 months, but this is a balance sheet that's really, really well positioned.
Chris, despite a lot of the reassurance that we got from some of the big bank CEOs this week, despite what we heard from Powell, investors still clearly very nervous, very worried about what has been playing out within regionals. How long do you think it's going to take to restore that confidence?
It'll take time. We know that we will emerge from this crisis. We always do. I think investors are really trying to identify when is the regulation, when are the regulators and the government going to step in? What is their max pain point from a bank perspective? Because what we're seeing now is we're seeing this spread and this contagion fear really just permeate the market. And what they don't want to do is create more of an issue, because the banks have great balance sheets. They have a lot of capital. They have a lot of liquidity. The deposits have stabilized. And what they don't want to do is create another wave of failures. That's not what's necessary. This is not a capital problem. This is a confidence problem.
Well, Chris, we appreciate you joining us on this Friday. Hopefully you have some plans to relax over the weekend after the week we had. Chris McGrady, KBW, head of U.S. Bank Research. Well, we are just getting started here on Yahoo Finance Live. Coming up, we kick off our coverage of the Berkshire Hathaway annual shareholder meeting. Our very own Brian Sazzi sits down with the CEO of Brooks Running. Plus, the U.S. economy added 253,000 non-farm payroll jobs last month. We're going to break down what the better than expected number means for the Fed. And tomorrow is the big day for the UK, the coronation of King Charles. We're going to go inside the wealth of the royal family. That's coming up later in the show. We'll be right back.
Stocks rallying in the final hour of trading for the week as regional banks bounce off their recent lows. Today's rally turning the Nasdaq positive for the week, but the S&P and Dow just around the flat line here for the past 5 days. Joining us now, we want to bring in Jeff Bierman, TheoTrade Chief Market Technician. Jeff, it's great to talk to you again. So I think investors are trying to figure out where the market is headed from here, what exactly we should be bracing ourselves for. What do you think that is?
Well, thanks for having me back, Sean. It was nice to see you again. Listen, every time I come on here, I have a theme that I attach to the market. So last time I was here, I called it the Seinfeld market because it was a market about nothing. Well, that's changed. We're now officially in the zombie apocalypse market. And what do I mean by that? It simply means this. There are only two sectors outperforming in the last 3 months. You have two flat, you have seven underperforming, you have the banks that have been routed, oil has been routed, retail's been destroyed. You got two sectors carrying the market. You got information technology, and you have consumer staples in the form of food and personal hygiene products. Now, what does that mean? It means the market's bracing for a very, very hard landing, and that people are like, hey, it's just duck and cover. Just buy me things that I'm getting ready just to survive in a zombie apocalypse, like food and personal hygiene, and get me an Apple phone so I can make a call or text somebody when we land there. So I see the market as potentially having a hard landing, and it's kind of at this point not factoring in a hard landing at all by the way it's acting, but things can change very quickly. And this 80-point rally today is clearly a gamma squeeze on the back of Apple, which I call the bridge over troubled water, because it actually saved the market for at least another day.
So let's try to turn this into a positive conversation. You mentioned consumer staples. What are you seeing in terms of the trend there? And can you elaborate on what a triple top signals to investors?
Yes, certainly. I'll address one each. Consumer staples are massively overbought, but for good reason. Their prices are up, their margins are up, their numbers are fantastic, and there's not much slippage in terms of volume. So they've doubled the price on most products, and they're happy about it, and it's showing in the profits. But on the other hand, okay, when you look at other sectors that are not carrying the market, because consumer staples are 9%, that's not going to get it done. But consumer staples make up 9% of the S&P. Technology information makes up about 29%. So about a third of the S&P is carried by two sectors. But we're up against a very key resistance level, Akiko, and that is 4,200. So this is what we call in the business a classic triple top. But at the same time, it's an ascending triangle from last October. So if you were to connect a line across the October bottom, which was 3502, to where we are now, you're having a compression of volatility into a very tight range. You can look at a Bollinger Band, but this is a lot easier to understand. One of two things is going to happen. We're going to come up to the apex of this triangle, and we're either going to break out to the upside, or we're going to fail and break out to the downside. Now, Thomas Bulkowski's statistics that he did over 12 years shows that in a classic ascending triangle pattern, there's a 64% chance of a breakout to the upside. But don't misconstrue to think that, because the probabilities are there, it's going to happen. You also need to have tailwinds push you through, such as lower interest rates or a rate cut not happening, or something like better sales not happening, or something to the effect like inflation coming down not happening. So it's going to be interesting to see what happens when we get there. But when it happens, it's going to break hard one way or the other, no doubt about it.
So, Jeff, what does that mean then for investors? How should they be positioned given the fact that it's still pretty uncertain about which way we're headed?
I would be actually tracking, Shauna, the gold market. Gold has been very strong. Gold is telling you that it's an inflationary hedge. It's an uncorrelated asset class that doesn't move with the S&P 500. So if gold tends to remain strong, I would be cautious. If gold starts to break down, that could be a sign of disinflation or inflation under control, getting the rates maybe at the end of the year for the Fed to pivot and turn down, and that could catapult stocks. So I'm watching gold. I'm also watching the bond market, and the bond market is kind of in no man's land right now. It's just trading sideways in a very tight range. So if bonds break down, likely the S&P will go with it. But if bonds can break higher, the S&P actually might go with it because it might be a signal that interest rates have not only peaked, but there's no more rate hikes in the cards for the rest of the year.
I mean, what's the magic number that they should be looking for when you talk about bonds?
It's not necessarily a magic number for bonds. I look at the bond futures at Kiko. So it's been trading between 129 and 132. But if it takes out that 129, 128, that's the key level. That's the bond level. The interest rate handle you need to watch is about 4%. We've been stuck between 3, 5, and 4% now for the better part of the year. And eventually it'll break one way or the other, because the more you compress volatility, eventually it becomes a coiled spring and it will make one massive move in one way or the other. So I'm bracing for some volatility, some big volatility around the corner this summer, perhaps in mid-June.
Okay, maybe we'll check in with you again in June. Jeff Bierman, always good to have you on the show. Appreciate your time today.
Thank you very much. Have a nice day.
Warren Buffett is set to kick off Berkshire Hathaway's annual shareholder meeting on Saturday. Tens of thousands of investors are expected to travel to hear the Oracle of Omaha's ideas on all things investing. Our very own Brian Sozzi is there now. Brian, everybody's always excited to hear what Buffett has to say in terms of investing. Feels pretty timely when you consider just how volatile things have been.
Before that event, Kiko, of course, it's just this environment we're in right now. The doors at the CHI Health Center opened around noon. The lines were really robust. A lot of people in here just doing some shopping. Like me, I picked up this stuffed Geico doll. Saw our head of news and resident Buffett historian, Miles Udland, walking the floor too as well, taking it all in. Lots of See's candies being sold as well. This is a packed environment, and amongst the just considering all the folks that we have talked to so far here, they are here to hear from Warren Buffett, the Oracle of Omaha themselves. A lot of shareholders, not just from the U.S., from around the world, coming here to see what Warren Buffett has to say about banks, big banks, in light of the crisis, to see what he has to say about Apple after their relatively strong earnings report and new $90 billion buyback. They are curious if he gives any indication when Greg Abel might take over. Now, there were some comments, I believe it was from Reuters reporting today, from Director Ron Orr, that Buffett has no intentions of stepping down as CEO anytime soon. So that was an interesting tidbit ahead of the meeting. But by and large, lots of crowds here, lots of people buying stuff, at least from inside the CHI Health Center, guys. There is no indication of a recession. People are buying $150 plus Brooks sneakers, $16 See's candies, and little Geico stuffed dolls like this, which set me back about $5. $5, it's still $5.
$5 is so, yeah, it's a lot. It's huge. You got two, I think, of Warren Buffett's youngest fans right there behind you. They're listening to everything you have to say about what we're going to be expecting here over the next 48 hours or so. But Saz, I'm curious, just from your perspective, what are you most looking forward to tomorrow?
Me, I'm very curious. It's a good question, Shauna. I'm very curious on how Buffett, his stamina is on stage. What is he talking about? How does he sound at the beginning of the conference, at the end of the conference? So just things you don't necessarily pick up on a transcript. And of course, everything that he has to say about big banks, obviously very much in focus. Also on Paramount, Warren Buffett went out in November 2022, picked up a large stock of Paramount shares, upped his stake in the company earlier this year. And Paramount surprised investors with a really bad earnings report yesterday. They cut their dividend, the stock went way down. A lot of people that I have talked to say Warren Buffett does not like surprises, so I'm curious to see if he comes back and fires at Paramount. But again, lots of things I am looking out for. But coming up next, one thing I'm looking out for, I mentioned Brooks Running Shoes. Jim Weber, the CEO of Brooks, a long-time Berkshire Hathaway investment. I'm going to talk to Jim Weber on the other side of the break about all things sneakers and consumer demand. We'll be right back. I'm going to need a couple.
Well, there's been a lot going on in the markets with the Fed's recent rate hike and continuing fallout from the banking crisis. My colleague Brian Sazzi spoke with Franklin Templeton CEO Jenny Johnson at the Milken conference. They discussed what she's hearing from clients amid all of the volatility. Take a listen.
The biggest issues you're hearing from clients is just they're concerned about, one, are we heading into a recession? Two, what does that mean to me? How much more are rates going to be increased? You know, volatility is difficult for your average kind of wealth or retail consumer. Institutions are a little more comfortable playing in that space, but we've been in really volatile markets, and that's probably what we're going to face going forward.
Talk to us about market resilience. It's something that I've been spending a lot of time at this conference thinking about. We've had a series of rate hikes, we have banking failures, yet the market is hanging in there. Why do you see this?
I think you have to unpack those a little bit. So, you know, rate hikes, we've gone through one of the shortest period of times of the greatest rate increases. I think that's why you saw the stress in the regional banking sectors is really around the pace in which rates increased. But we're getting to the end of it. But as you get towards the end of that cycle, then people have predictability, and I think there's more stability of that. So we've really gotten towards the end of that cycle. So I think that you've gone through that. And then the second thing is in the regional banking sector, it was very much contained, right? And I think that the Fed did a great job, and the FDIC, the regulators moved in quickly and backstopped the depositors, and that was really important because in the end, banking is about confidence, and you've got to have confidence that your money's safe. And so by that backstop, they quickly gave depositors confidence. Now, that didn't mean that they weren't going to move their money out of their checking account into, say, a money market fund, right? Because the differential returns are significant right now, which then continue to have stress on those regional banks. But I think you're really through that crisis.
What are you telling clients right now that have lived through this the past month and a half? And clients, I imagine, that in some respects are nearing retirement.
So, listen, if you're nearing retirement, I think the good news is for the first time in a decade, you can actually get returns in fixed income.
And go on vacation.
And go on vacation, there you go. So, I think what you're seeing clients want to do is still stay fairly short term, stay pretty conservative, higher investment grade type. You can get great returns in investment grade. And if you're near retirement, that's a good, safe place to be. I think if you have more of a risk appetite, there's some interesting things that are starting to open up. That I think, one, institutional investors have, we see a lot of demand in like secondary private equity. We own Lexington Partners, and you see a lot of interest there because they can kind of reset the private equity prices. Private credit, our team, Benefit Street Partners would say, seeing the best deals they've seen since the global financial crisis. The challenge is a lot of the institution LPs they're overexposed to the alternative space, so it's hard for them to deploy capital. But it's actually a great time if you have cash to invest in some of those spaces. And then I'd say, emerging market debt, we're starting to see interest there.
What about millennials? How are they interacting with you and your team, and what are they asking for, and how are you preparing them for retirement?
So, look, we really distribute through financial advisors. We're really big believers that you're going to be better served by having somebody who spends their entire career and day thinking about markets, right? And that the best lesson you learn in difficult times like this is diversification is really important because you don't know where that next crisis is going to be. And so be diversified. If you're young, you also have to stay in the market. From 2020 to 2022, there's 5,000 some 200 something trading days. If you missed the best 10 trading days in that window, you missed something like 47% of the returns over that period of time, right? And there's nobody who can tell you when those best days exist. And so I think, again, for the reasons we talked about where you're at towards the end of the rate cycle, I think we may have a recession, probably have a mild recession, but you got to stay in the market in these times. And if you're young, you can withstand a bit of that volatility.
Sure, maybe. I think I'm still, I mean, maybe I could, but talk to us about how you've not rebuilt, but tried to bring Franklin Templeton into the next generation. The Legg Mason acquisition was huge. Where is that, and are you eyeing any other deals? Because this is a very competitive industry right now. It always has been, but especially right now.
It's very competitive. Yeah, no, so we've done 8 acquisitions in the last 3 years. And we set out in like 2017 to recognize that we needed to be more in the private markets just because of secular trends that are happening there. And so some of our acquisitions reflect that. We're now $260 billion in alternatives. But for the younger generation, again, we sell through financial advisors. We don't do a lot direct. We have some interesting, sexy things that I think will be attractive to younger generations. We're actually very big in tokenization. We're big believers in blockchain. We have the first tokenized money market fund that we worked with the SEC to launch. That is attracting. You can download the Benji app on your app store.
The Benji app.
The Benji app.
Is there AI behind all of that?
So it's right now it's a traditional government money market fund, right? With a shareholder record built on the blockchain. But we just, for those who are big in this space, we just actually went cross-chain and connected to Polygon. So any businesses or that are built on the Polygon, which is layer 2 on Ethereum, we are now have a money market fund, which is appealing. Money market funds are priced at 1, and you earn a 4.5% return. So it's a nice way to kind of park money as you're figuring out, and we're trying to bridge the traditional markets with what we think is going to be the future of a lot of investing built on blockchain, as you think about ways to tokenize illiquid assets and bring them and democratize them for all investors.
And our thanks to Brian Zazzi and Franklin Templeton CEO Jenny Johnson. Coming up, we will check back in with Brian Zazzi, who's live at Berkshire Annual Shareholder Conference. We'll head out to Omaha when we come back. Let's get back to Brian Zazzi in Omaha with the CEO of Brooks Running. Hey, Zaz.
All right, thanks so much, John. I'm here with Jim Weber. Jim, good to see you as always. You're a bit of a rock star here. Everybody's taking photos in front of you. The crowd is packed. Good to see you here.
It's great to be in Omaha. This is such a unique event. We'll sell as many pairs of shoes here as we would at a great marathon expo. And it's because of Warren. We put Warren on the shoe and everybody wants a pair.
I got here, I've been here maybe an hour and a half, 2 hours, and the lines at your booth are snaking around your booth. What do the sales look like?
You know, we brought 6,000 pairs in, and this is the record. It's interesting, you know, last year people were coming back. We've never seen this much activity here, so it feels like there's a lot of people in Omaha, and they've got to lace up for our race. We got a 5K race Sunday morning too.
That's great. Talk to us a bit about the state of your business. How was the first quarter? I think we saw a lot of retailers a little cautious.
Yep.
Sales slowed down a little bit. What did you see at Brooks?
So far, here's what we're seeing. You know, we started to fulfill demand after the supply chain craziness. We were up over 40% in Q4. We're up 20% in Q1. So we're seeing great demand. As of last week, retail in the U.S. is fantastic. We're still seeing across channels really good sell-through, at least in performance running. Europe, we're seeing a slowdown. The last 2 months, Europe has definitely slowed down. We think the economy and concerns are starting to take hold there, but U.S. retail is quite good.
So when you crunch the numbers in the U.S., do you see anything that would suggest a recession is on the horizon?
Wow, I think we're all cautious. I think we're all cautious, and there's anxiety, there's apprehension. But we've seen in the past that running often can kind of transcend a recession. So we're pretty confident, cautiously, that running is going to be fine through this. But I don't think anyone knows. Retail is really hard to judge for fall. We think the consumers there, employment's good. You know, households are still in good, healthy shape. So I'm optimistic, but hard to know.
Has inflation started to ease?
Absolutely. We're seeing it in supply chain. Oil's now, I think, below $70 a share. So supply chain is normalized both in terms of service levels and costs, and that's really big for us. And even materials inflation is so much driven by the petroleum market, so we're definitely seeing inflation settle down.
Explain to us the popularity for your shoe, because you have, what, 23% market share?
Yeah, at measured retail in the United States.
There's a lot of new competitors in your space.
There is.
Why are you able to hold on to that market share?
You know, we've been at this for 22 years of focusing only on the runner and really trying to build the best gear from head to toe. And we think you have to earn it. You know, for people that are really putting in mileage, 20 miles into the shoe, they know if they're ever going to buy that shoe again. So we've built a lot of trust, I think, with runners over time, and we feel like you got to earn them every time. You know, we wake up every day and we feel like we have to earn the runner's support for our gear, and so it's very competitive. They've never had more choices, but we're optimistic about our ability to service the runner.
I went to your website. You're selling sneakers with nitrogen on them. Is that marketing? Is that going to make me run faster?
I love engineering. I'm not an engineer, but I love it. We've been engineering materials specifically for running shoes for 20 years. This material is actually really special. Normally, when you're engineering material, you have to trade off lightweight, cushioning, resiliency properties, durability. We saw no trade-offs. This is better on every front, and it's a molecular level. It's a lighter molecule, but the cushioning and the durability is among the best we've ever seen.
So what you're saying is
it's really good. And you're going to enjoy it more.
Where's Brooks on the sustainability push? I think we've seen brands like Airbirds come in here, try to pull chemicals out of their products. Is that something you're focused on?
You know, we've set some goals over the next 15 years that we think the runner is going to expect us to really limit our impact on the planet because they run outdoors. So, you know, our Ghost is our #1 selling shoe. It's the #1 selling running shoe in the United States. It's carbon neutral, and it's done in a combination of 60% recycled materials and carbon offsets. We got a long way to go, but we just think the runner's going to expect it. So it's an engineering challenge. And then we're working on circularity too, and running shoes wear out, and bringing them back and recycling the materials. We think it's table stakes over the next 15 years. We got to figure it out.
As a portfolio, as a company inside the portfolio of Berkshire Hathaway, run by Warren Buffett, what has that experience been like over the past decade?
You know, I've learned a lot because, you know, we've always treated all of our owners as investors and really tried to steward this brand and business to build value. But I underestimated how much ownership can matter because they're long-term thinkers and they know that the brand is in the mind of the customer, and that's where all of our revenue growth, all of our margin, all of our profitability comes from. So they're totally supportive of us building the brand in the minds of our customers. And everybody can say that, but they're really committed to it, so we couldn't be happier. They're supporting us to invest against the growth of this brand, and it's really fun.
The other side of this is no one lives forever. and no one can be a CEO forever. When Warren is not here, what happens?
Yep. Well, I think the board has made it pretty clear. Greg Abel's going to be the guy. I report to Greg now, and Warren sees everything we do, of course. And is
it different dealing with Greg than Warren?
Well, actually not. The philosophy is the same. The culture is the same. The focus on cash flow and returns is the same. Understanding a brand. The difference is Greg's a faster runner than Warren. We had Greg out for a strategy review. He's sample size. He tried on all of our prototypes in our development timetable for the next 3 years. It's really powerful because he's a runner. So that's a big difference. He's faster.
From the outsider looking in, and lastly, is it fair to say that Greg is a true disciple of Warren? Can you see the similarities between the two?
Oh my, I think the business savvy and the business mindset, absolutely. Absolutely. We have great conversations, and he likes Brooks for the same reasons that Warren liked Brooks. And that's important to us, right? We have to earn their trust and support. That's my primary job. And we work hard to do that, and I think we've got it.
Now we'll let you get back to working the floor. You're a very popular and in-demand guy here. Brooks, running CEO, Jim Weber, good to see you. Appreciate it.
Brian. Thanks for having me.
Guys, back to you.
Brian, I have to say I'm feeling a little guilty listening to Jim. I can't remember the last time I went for a run, but I'm going to definitely try on those shoes and maybe take it for a run. Brian Sozzi there for us in Omaha with Brooks CEO. Thanks so much for that. Well, coming up on the other side, 3 stocks to watch as we count down to the final closing bell of the week. We'll be right back.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes. We've got Carvana, Apple, and DraftKings. Kicking it off with Carvana, it's the top trending ticker on Yahoo Finance today. Shares are surging. You're looking at gains of just about 25%. We had been up about 40% in earlier trading. The struggling used car retailers' Q1 earnings beating the street's expectations also predicted that it will reach adjusted profit in the second quarter, much earlier than expected. Carvana has been working to cut costs and restructure its business. Remember, shares plunged 98% last year. Rising interest rates really slowed down demand. So that gain that you're looking at right now of up 25%, we need to put that in perspective because Carvana trading just above $9 a share. Well, analysts weighing in on this report here, analysts at Piper Sandler and also Cowen, both raising their price targets on the stock, with the team at Piper Sandler rating Carvana is, quote, coming back from the brink. So, Akiko, a little encouraging. The company certainly, though, has a ways to go.
I mean, coming back from the brink is the key, right? They're not back yet. And to your point, it's important to highlight just how much that stock has declined, down more than 80% over the last 12 months. Yes, the results here with Carvana, I think, point to the fact that we have started to see used car sales kind of stabilize after seeing the declines. But at the end of the day, this company is really about having to cut down some of their debt. You look at their total debt and leases rising to $8.7 billion within the quarter. You still have a rising rate environment. You've got customers who are still pinched when it comes to used cars.
Right. Yeah.
I'm not sure how bright the future is.
Right. Yeah. You make excellent points there. And Shauna mentioned Piper Sandler. They did couch their, expectations with regard to it. Of course, they did boost their target, but they said this stock isn't for the faint of heart. And you can see why. I mean, it's a massive surge today, sure, but certainly as you point to what occurred last year. So Carvana's made a lot of progress with regard to reducing inventory and cost cutting, et cetera. But it's got a long way to go from where they were, say, during the pandemic. I mean, it was one of those that became a pandemic darling, but they are certainly trying to change that picture now. I want to switch gears and look at another one that we've got in focus today. My pick today is Apple. That stock gaining about 4% right now, close to 5% following its latest quarterly report card. That was better than expected, both top and bottom line. iPhone strength return and services revenue posted a record. They talked about people spending in the App Store more than they did last year. I listened to that earnings call, and CEO Tim Cook also talked a lot about emerging markets, particularly India, saying that it is an incredibly exciting market. And a lot of people, he commented, are entering the middle class there. And Cook said he hopes they can convince some of them to buy an iPhone. So the iPhone has returned as its crown jewel. As you know, the previous quarter, they hit a trouble spot in terms of a rare miss there.
Yeah, certainly. And India wasn't the only emerging market that Cook and team had pointed to there in terms of where we saw some of that strength. For analysts weighing in, pointing to the strength that we saw in Mexico and Indonesia, also in the UAE, all areas that could be future growth opportunities here for Apple. But Diane, like you said, iPhone sales, that was certainly the driver last quarter, with revenue gaining there, with the revenue of just over $50 billion there. Obviously beat in terms of what the street was expecting. And Akiko, the big debate going into this report was whether or not Apple was overvalued, whether or not the fundamentals really matched up with the rally that we have seen since the start of the year, with shares up just over 30%. And it seems like, at least from today's move, that the street seems to be satisfied with these numbers.
Yeah, they're satisfied largely because Apple, when you think about all the tech stocks and the volatility that's happened, has kind of been the one steady play, right? But I want to get back to that point that Diane made about India, because there's so much excitement around this market. We keep hearing that in light of the challenges they're seeing in China, India could be the next one. We've heard this before, and I know I keep saying there's a word of caution here, but when you think about where India has been, they've really struggled to build out their infrastructure. They have a very fragmented market. And at the end of the day, when you think about the price point for Apple and how they compete in the Indian market, it simply hasn't been right in terms of where China has been versus where consumers are willing to shell out in India. So certainly a lot of promise there. And sure, Apple has to kind of look to India given the challenges they've seen in China. But it's going to be interesting to watch that play or that storyline, because we've heard from many companies before saying this is the next bet that haven't necessarily materialized. Let's talk about DraftKings now. That is my pick for the day. That stock hit a 52-week high today, soaring more than 15% on better than expected results. And that's kind of putting it mildly here. Revenue rose 81% compared to the same period last year, while the company also boosted its outlook for the year. CEO Jason Robins saying DraftKings is now poised to reach profitability on an adjusted EBITDA basis in the near term. But analysts remain divided on the path to profitability. You had Needham's Bernie McTernan saying DraftKings' performance in the quarter provides encouraging data points for the future profitability of the enterprise. Stifel analysts saying though profitability remains several quarters away with the risk of market share compression. And Sean, a lot of people looking at where that next market is, saying there's not a lot of states that are now going to be opening up for sports betting. And that's going to be part of the challenge in terms of being able to maintain this kind of growth for DraftKings.
Yeah, certainly. You're right there, Akiko. The growth extremely impressive there. You mentioned that revenue growth on a year-over-year basis. Also, monthly unique payers, 2.8 million. That's up 40% from just a year ago. And you're talking about those types of gains outside of the heart of football season. Yes, you had the Super Bowl, but March Madness was a huge win here for DraftKings. But the company will really need to step up and really try to separate itself from the competitors within the space, because we know right now it's a second player here to FanDuel. FanDuel certainly accounts for most of the market share. We've heard some reports, there was a Bloomberg report just over a week ago that DraftKings is planning its own streaming service, really pushing into the video space to better compete with some of the offerings that FanDuel has. But we'll see what is going to keep, if anything, really can keep this type of momentum, because you talk about the fact that most of these states have already legalized gambling when we talk about the ones that were going to do this in a timely manner. Right. So you would think that growth is going to cool and potentially pretty significantly.
Yeah, that's certainly one of the headwinds coming up for DraftKings. I mean, look, the stock has outperformed the broader market in general in terms of what we're talking about this year in that context. So it's certainly doing well. And they say they're going to be hosting an investor day later this year. But yes, again, that headwind coming up of which states will be coming down the pike in terms of legalization. We know Kentucky expected to happen this year, but it remains to be seen whether North Carolina or Vermont will occur in 2023, which would actually, in terms of the execution of that, happen in 2024. So, of course, in terms of people piling into the stock, sure, it's off the back of some strong numbers. And some of this is obviously, buy the rumor, sell the news kind of play that we'll see. So we may see that stock continue to run up this year as a few other states come into the pipeline. But that's certainly one of the challenges that DraftKings has.
We'll see if this momentum can continue. All right, well, coming up, we are recapping the strong earnings coming out from the food industry. Chipotle, McDonald's, Starbucks, all with impressive same-store sales numbers. We're going to break them all down on the other side. Investors having plenty to chew on over the past couple of weeks when it comes to fast food chains and also just more largely speaking, the food sector here, because Starbucks, Yum Brands, Chipotle among the names that have released their quarterly earnings here within the past few days. Joining us now to break it all down is Brooke DePalma. And Brooke, when we talk about the big takeaway from this sector so far this earnings season, what do you think that is?
Yeah, well, we saw McDonald's, we saw Shake Shack. We just saw so many companies give us an inside look at the state of the U.S. consumer and ultimately the health, the willingness of them to spend, and ultimately just pushing aside those higher prices. And so taking a closer look, we saw U.S. same-store sales growth across the board here. Some of the standouts include Wingstop up 20.1% year over year, entirely driven by transaction growth, the company said. McDonald's up 12.6%, boosted by higher prices and more customer traffic in their locations as well as on their digital apps. In addition to Starbucks, up 12%, driven by an uptick in transactions as well as an increase in average ticket size. And Chipotle, largely boosted by those higher menu prices. They were one of the fast casual chains and one of the restaurant spaces that took the highest increase in menu prices, up about a range of 10%. And so largely higher prices, but customers undeterred. And so I would say my top takeaways here, consumer remains resilient. Analysts in the street continue to use that word resiliency among the U.S. consumer. In addition to that, a combination of higher traffic as well as higher prices led to that same sales growth. And at the end of the day, Shauna, labor availability has improved. Retention also has improved. Randy Garutti, Shake Shack CEO, saying that because there's less turnover, they're actually able to gain sales and they're doing faster throughput. They're able to increase their sales momentum there. And so ultimately, labor improvements, a big win that we've been waiting to see, really post-pandemic here.
Billions of consumers. That's partly why we have seen so many of these companies move aggressively on price hikes.
Right.
Are we expecting a little more caution this year if we look to the latter half?
Yeah, well, that was sort of the emphasis. It's only the first quarter, and so a lot of these executives are starting to wait and see what exactly happens. But Starbucks CFO telling us earlier this week that she expects them to go back to more normalized historical levels of pricing. That's about 1 to 2% at Kiko. But if you take a look at some other brands, for example, Yum Brands CEO shared a similar tone. And here's what David Gibbs, CEO once again of Yum Brands, told Yahoo Finance earlier this week.
I do not anticipate taking as much price in 2023 as we did in 2022, simply because inflation has abated for us in terms of our key input costs on the food side, and even the labor market has gotten a lot better. We now have more applications, more team members in stores, better staffed stores.
And in addition to that, we also saw Chipotle, as Akiko noted before, really waiting and seeing what's happening, putting forward that cautious tone. They said that they don't have any plans to increase prices right now as they just wait and see what food inflation, what labor inflation comes towards the rest of 2023. But really across the board, what we saw this past earnings season is that the customer is willing to spend here in the U.S. And not only are they going to these fast food stores, but they're also spending perhaps a little more while seeking value at other places.
See whether or not that trend continues. All right, Brooke, great stuff. Thanks so much. Coming up, we are counting down to the closing bell on Wall Street. Once again, gains across the board for today. The Dow up just over 500 points. We'll be right back.
people, the ranks of the healthcare uninsured, it's low. It's as low as it's ever been. And so I think the balance that the president is drawing is to show the progress we've made. And by the way, as someone who spent a lot of time on numbers days talking to experts like yourself, what so many of the pundits say right now is, oh my goodness, we have a recession in the offing. This economy is built to last. The investments in infrastructure, the bills that this president has led the passage of, they're just beginning to show their impact. So what we have to do now is to demonstrate the progress we've made, but also be honest, as the president has, about the unfinished business. We still have to continue that fight to tackle inflation. We still have too many people who are uninsured. And the differences between the approach of President Biden, which has worked. How many times did Donald Trump talk about infrastructure week? This president, Joe Biden, got infrastructure done. And that unfinished business is significant. And the differences between the two parties, the other party wants to take us off a fiscal cliff with the debt ceiling. That's not good for anyone in America. And that's what we're going to talk about, is what we've accomplished, the unfinished business, and the differences between the approach of Joe Biden getting things done and the approach of MAGA extremists, which is to burn the house down. That's not a strategy for success.
Well, Tom, let's talk a little bit more about that fiscal cliff, because we certainly are looking at a showdown on the debt ceiling. President Biden used the opportunity today to say that the last thing the country needs after all we've been through is a manufactured crisis. How big of a risk, or how real is that risk, do you think, that we could potentially default? And what does that mean for jobs?
Oh, that would be catastrophic. And that's why 3 times during the Trump administration, Republicans passed increases in the debt ceiling. I think it was 7 times in the Reagan administration. We have done this on a bipartisan basis. They want to have a conversation about budget priorities. You do that in connection with the budget that Congress must pass. You don't do that in connection with the debt ceiling. The Treasury Secretary has been very clear. We're very close to the precipice of a fiscal cliff. And the challenge here, and the reason this is different and in some ways scarier, is it only takes one Marjorie Taylor Greene to raise her hand and call for a vote on the tenure of Kevin McCarthy. And there are folks on the far right who are content with burning the house down. And that's not what America needs.
At the end of the day, there is a negotiation, though, here happening. We know the president's going to be meeting with the House Speaker next week. Do you think that is there a temporary solution here where you raise the debt ceiling just for the short term to allow for more negotiation? Or given the condition we're in right now, is that not the right approach?
Well, I think the right approach is to have this conversation during the budget cycle, which is what we do every year and what we should do here. Again, people across an ideological spectrum. I talk to a lot of folks on Wall Street, people who are registered Republicans, independents, Democrats. What they all agree on is this would be catastrophic. We've always kept our word in our debt obligations. We have a budget cycle coming up. The fiscal year ends September the 30th. We have that budget discussion and we bring together both sides and we come together around a compromise. That's what we need to do. Again, how many times was the debt ceiling raised during the Reagan administration, during the Trump administration, when they had complete control in 2017 and 2018? They didn't take us to the edge of this fiscal cliff. These sort of threats are really going to hurt our economy. And I hope they will come to their senses and realize that the conversation should be had in connection with the budget for the upcoming fiscal year.
Tom, let's look ahead to 2024 because we just heard Senator Ben Cardin is going to be retiring. Your name has been thrown around as a potential person that could throw their hat in the ring, that could potentially pursue his seat. Are you considering a run for Senate?
No, I'm not. And there's going to be a great field in Maryland. And I'm looking forward to making sure the seat stays in Democratic hands. And I'll tell you what else I'm looking forward to is a 2024 election where, again, we tell the story of what we have done under this administration. And there's been so much accomplished and what the unfinished business is. And then the differences between the MAGA extremism and what Joe Biden has done to bring America together. I am proud to do the work I'm doing here at American Bridge, where we are telling the story through the lens of real people in Pennsylvania, Wisconsin, and elsewhere of the progress that they have made. They've been able to sustain their small business or start their small business because of help from the administration. They're paying $35 a month now for their insulin. Because of work that Joe Biden did. These are the stories that everyone has to tell, and it's all hands on deck enterprise, because I want to make sure that every eligible person gets out there and votes. And unfortunately, the other side's working really hard to make it hard for people to vote. I think that's wrong, and that's why I'm going to work so hard in the next year and change. It's about 550 days till election time, and every single day we're going to be working hard to re-elect Joe Biden and make sure we keep the Senate and keep the House.
Finally, Tom, we're talking about the labor market, but there's a big hole right now with the Secretary of Labor, that nomination for Julie Su being held up. You've got business leaders who have urged Senate leaders to confirm. But on the other hand, you've got other business leaders who've said we're a little concerned about her pro-labor stance. What do you say?
Julie, I've known Julie for over 25 years. I've watched her work with people across an ideological scale, whether it's grassroots advocates or business leaders from Fortune 100 companies. Julie has all the tools that you need in a labor secretary. She's a great listener. She understands the struggles of ordinary people. Her parents were small business owners. And I'm confident at the end of the day, she will get confirmed. She got confirmed for her deputy secretary position, and I'm confident she'll get confirmed for the secretary position. We need a confirmed labor secretary. I know the work of that department pretty darn well, and I want to make sure she gets confirmed. And I know she will work across the aisle. She understands I'm not just the Secretary of Labor for Blue America. I'm the Secretary of Labor for America, for everybody, for business, for workers. We need someone who's going to make sure that we stand up for opportunity for everyone.
Tom Perez, we really appreciate you taking the time to join us here this afternoon. Former Labor Secretary under the Obama administration.
Have a wonderful day.
You too. All right, well, sticking with jobs, employers adding 253,000 new jobs in April. Strong pace of hiring exceeding expectations. That's marked the 13th month in a row. But what's this all mean for President Biden as he looks ahead to re-election? Yahoo Finance's Rick Newman here with this week's edition of Bidenomics. So, Rick, like Kika was just talking about prior segment here, he has a tough line to walk just in terms of the slowing growth, but also wants to get inflation under control. What do you think this means for his run in 2 years?
A great jobs report for President Biden today. Obviously, employment is slowing. That's what everybody expects, and that's actually what the Federal Reserve is trying to do. And we are going to get the next inflation report next week. And most economists are saying they expect the continued downward trend in inflation. So that's all going the right direction. I actually think the bigger developments this week were what we have seen with regard to regional banks. I mean, we had this failure and then takeover of First Republic on Monday, and you had regulators and you had bankers, including the leaders of some of the largest banks in the country, saying that's it. The problem is over. And markets did not believe them. And we saw this ongoing sell-off of regional banks, and then something of a recovery late in the week today. But there's a real problem going on here. I was out at the Milken Institute Global Conference in Los Angeles this week. Akiko, I saw you there for a hot second. One of the dominant themes was not so much that we're going to have more bank failures, but that we're going to have a really tough credit crunch, which is already starting. And that is going to result from, first of all, banks know regulations are going to get tighter. We saw regulatory reform proposals come out from the FDIC and the Federal Reserve recently. And banks are just tightening up as they think maybe a recession is coming. Plus, they have less money to loan. Now, I don't think anybody knows how severe this credit crunch is going to be. But it is going to be a significant thing in the second half of the year. And nobody saw this coming. I mean, 2 months ago, before Silicon Valley Bank failed, nobody had credit crunch on their list of things that could go wrong in 2023. And now I think it's at the top of the list. So that makes me worry about where we're headed with the economy.
Yeah, Rick, on that point, I mean, we talk about the regional banks. The concern isn't just about the deposits now, but to your point, the credit crunch, because the expectation is there's an impending type of regulatory crackdown that could potentially come because of what happened with SVB. I want to bring this conversation back to politics, though, because President Biden has said he's going to run again. I hate to talk about messaging when we're so far out, but in his camp, they're thinking about it right now. How do you think he shapes this economic message when we've got inflation still at very high levels, but he's got a very strong labor market?
I think you accentuate the positive. I mean, there's no way you're going to hear President Biden or probably any incumbent president say, well, things are okay right now, but be ready for doom in the future. The way I'm saying it, I'm not running for election for anything, and I'm not responsible for stewardship of the economy. President Biden is. So he's going to accentuate the positive. And the balancing act there is you want people to know the good things that are happening. And that's arguably been a problem for President Biden. I mean, we've had an extraordinarily strong labor market during his presidency. And yet consistently, we've had confidence levels at recessionary levels. That's a bit of a puzzle. People are bummed out and they think the economy is much worse than it is on paper. So if you're Biden, you have to accentuate the positive. But when people are feeling pain, you have to acknowledge that. He's been trying to do that. I mean, he keeps saying, that's part of his slogan, finish the job. Part of finishing the job is get inflation under control. So that is the messaging we're going to hear from him. He's going to have a problem if the economy really does hit the skids and we finally get this recession that some people have been predicting seemingly forever, which could come by the end of this year or maybe the beginning of next year.
Yeah, I mean, you could argue there's a disconnect right now between the data and the headlines, but if that doesn't exist at some point, then to your point, that's kind of a problem for the president. Still a long way to go, Rick. Going to keep you busy. Rick Newman, as always, thanks so much. Have a good weekend.
Bye, guys.
Well, high interest rates and regional bank turmoil has raised concerns among investors about the state of the commercial real estate market. It is something Yahoo Finance Brian Sazi asked David Hunt, the CEO of PGIM, about at the Milken Institute Global Conference Rick was just talking about. Take a listen to the conversation earlier this week.
So I think that we will see some pressure on the commercial real estate market for sure from higher rates. And I also think actually from the banking turmoil, as I mentioned, there'll be less credit provided from that group of players, and they're important lenders into that market. So that will create pressure. On the other hand, the pressure that creates opportunities for non-bank lenders. So, we actually would see, if you take the longer term, again, view of this, is that as we go through a credit cycle here, that the non-bank players will be well positioned for it. And as we look at our own track record as we've gone through downturns, our credit losses have actually been very manageable. And sometimes it's not a bad thing to flush out the system a little bit.
The consensus seems to be that the Fed is about to pause its hiking campaign, maybe a good thing. Do you think the broader equity markets will be off to the races now that they might be done doing this?
I think our view remains that at the moment the markets are over-optimistic around where we're headed with both rates and recession. And what I mean by that is that actually they're underestimating the strength of the American economy, which actually is in very good shape. The consumer is continuing to spend. Early days they spent money on goods, now they're spending money on services, but the economy is actually doing pretty well. That's the good news. The bad news is that means the Fed's going to have to do more to begin to slow aggregate demand. So our view is that rates are going to have to stay higher for longer than is currently priced into the market, and that's true both for the fixed income markets as well as the equity markets. So the latter half of this year, I think, is going to see some volatility, and we should be prepared for that.
Our thanks to David Hunt and, of course, Brian Sazi there. Well, coming up, sky-high real estate prices might be coming back down to earth. We're going to break it down next. Well, San Francisco is known for its sky-high real estate prices, but they may be coming back down to earth. Let's bring in Yahoo Finance housing reporter Rebecca Chen, who's here with a closer look. And Rebecca, we've talked a lot about the struggles in the Bay Area, especially as tech companies go for more remote work. What are you seeing in the market there?
Based on the data that we saw with San Francisco market, the average price has come down 23% in just 9 months. In median price homes in San Francisco, it was about $1.5 million. It's about $1.5 million right now, whereas last year it reached $2 million. So although neither of these numbers are low, in fact, they are 4 times higher than the national average. They are coming down in a very short amount of time. And we're also seeing similar decline in other cities in the Bay Area. Santa Clara, which is the Silicon Valley and where a lot of tech headquarters are at, prices dropped 15% in just a couple of months within this year. And we are seeing decline in other places as well.
Rebecca, when we talk about that big of a decline, that's really bucking the trend that we're seeing in a lot of major cities here nationwide. What are the biggest factors contributing to that?
So the high interest rate that is cooling the market across the nation is one. But there are some elements that are very specific to the San Francisco area. Along with the tech layoff, unemployment has ticked up to 3.1% this year. And IPO has really fallen in the market. They're not as generous as before. So employees are not getting the stock comp like they used to. And the VC money for startups has also dried up. The city also has a net bound out migration where people who have the option to work from home are choosing to work in the city that's a lot less expensive. So the experts that we have been chatting with said that with the strength of the wealth in the tech ecosystem, people are just not aggressive when it comes to buying homes.
And it's always tough to call the bottom in the market, especially in the housing market right now. But can we expect anything different for the spring buying season?
It is a little bit difficult to tell for the moment. After all, this is a city that made a huge comeback after the 2000 dot-com bust. And a lot of people we've spoken with say San Francisco is still a great place to live. It has a lot of creativity, a lot of company, and people and culture. So the city will always be very popular. And given the many tech companies reported a positive, better than expected earning last week, we're really not sure where it will go next, but we're keeping the tab.
All right, Rebecca Chen, great reporting. Thanks so much for joining us here. Coming up, Congressman Mike Flood joining us from the Berkshire Hathaway annual shareholder meeting to discuss the latest in the U.S. banking crisis, also what he will be watching from this year's meeting. We'll be right back with that. The buzz surrounding AI is only getting louder, but what does it mean for jobs? Airbnb CEO Brian Chesky and U.S. Commerce Secretary Gina Raimondo weighed in on this exact topic on Yahoo Finance earlier this week.
The nearest term impact it's going to have is it's going to make everyone in tech companies more productive. Software engineering will be more efficient because computer programming is a language. And now suddenly these tools can, in some ways, do development just as good as a person, in some cases better than a person.
There is no question that AI will change the way we work. And in many ways, that will be a good thing. It will make our jobs easier. It'll make us more effective. It'll make us more productive. But it's also true that it's a brand new technology that's very powerful. And that's why we have to be, thoughtful to make sure people don't get hurt.
Let's talk a little bit more about this with ZipRecruiter Chief Economist Julia Pollack. Julia, it's great to see you again. So IBM, we heard this week, planning to replace almost 8,000 jobs over time because of AI. How do you see AI disrupting the workplace?
So traditionally, new technologies have come online and made the most educated, highly skilled workers more productive and replaced lower skill, low wage workers. This time around, things could be very, very different, with AI, generative AI, actually disrupting many highly paid white-collar jobs in legal services, accountants, teachers, what have you, HR staff, back office staff, administrative staff, et cetera, et cetera. And it's the kinds of jobs that are fairly low-wage jobs, that are very manual, that are not at much risk at all. It's janitors and gardeners, it's maintenance technicians who are at very little risk of this technology.
People hear more productivity, more efficiency, and automatically it becomes, well, here are the job cuts coming because of AI. But we've also heard the argument, no surprise, from tech companies who say there's a lot of job creation on the other end. What are some of those jobs that you're looking at?
Well, the first exciting sign to come out from this technology is a study that was just released about the effect on productivity of customer support agents among 5,000 customer support agents in a Fortune 500 company. And what actually happened there was that AI tools, ChatGPT style tools, raised productivity for the youngest, newest, least experienced workers the most. It gave them a script, it showed them examples, and it got them up to speed much more quickly. And so that is very encouraging news for employers in these very supply-constrained industries right now, who are struggling to fill vacancies and who are very nervous about reducing their standards and hiring workers with less experience and less education than they're used to. But this new evidence from MIT and Stanford suggests that actually perhaps there isn't as much of a supply constraint in the labor market. Perhaps we can hire younger people and get them up to speed very quickly.
Julia, how do you see this really impacting those who are just graduating from college? And in terms of the trends that you're seeing there at ZipRecruiter, how many of these recent college graduates are thinking about AI and its impact on jobs?
So new graduates tell us that most of them used it for their college homework at some point. Even though it's a relatively new technology, they jumped right in and adopted it. About 70% are using it for their job search, to discover different jobs, to write a resume. So they are very upbeat about this technology. They're not too worried about it replacing them, and they're already finding ways to become more effective and more productive.
What does it mean for the hiring process? I mean, we know for years that businesses have used AI as a way to sort of weed out the initial phase of the hiring process, maybe trying to find the right candidates to interview. I'd imagine with the latest developments, that's only going to be accelerated. What are you looking at in terms of what this is likely to do for that process?
Well, I expect that it's going to raise the quality of every application, right? If you can just take a terrible selfie on your phone and have it turned into a beautiful corporate headshot, if you can answer a couple of questions and have a beautiful resume, every job seeker, every candidate is going to start looking amazing. And that is going to push employers to want to have instant connection with a real human to see who you really are. If the signal is lost in your resume, employers are going to have to look for something else. And I think they're going to go back to the old-fashioned person-to-person contact.
Julia, what are you hearing from the employer side of this? Because when it comes to the labor shortage, and you touched on it briefly earlier, have we made tremendous amount of stride there? Are employers able to find those skilled workers that they need? And how does AI play into that?
Absolutely not. In the consumer services industries where employers are adding lots of jobs, there are still very, very high churn and very, very high wage growth pressures, and there are very few candidates. And this is going to be a long-term issue. The working age population in the United States is not growing anymore. The share that are college educated is growing. And so we're going to run out of non-college educated workers prepared to do these jobs. And AI is probably not going to help that much. So employers in those areas need to understand that this is going to be a tough slog, and they need to make these jobs more attractive. On the other end, you're seeing companies like IBM pausing hiring and replacing HR jobs and accounting jobs and legal services jobs with AI. But there's still likely to be very little shortage of demand for highly educated workers in the United States. This is a growing economy, and this jobs report today, I think, suggests that we aren't really at a ceiling. That the longer the expansion goes on, the more and more jobs are created.
ZipRecruiter's Julia Pollack, appreciate you joining us on this Friday. Have a good weekend. Well, Berkshire Hathaway's annual meeting is almost here. The big meeting kicks off tomorrow, Saturday, in Omaha, Nebraska. Investors are eagerly awaiting to see what Warren Buffett has to say on the turmoil that has engulfed regional bank stocks. Let's bring in Nebraska Congressman Mike Flood, member of the House Financial Services Committee. He's already there on the ground. Congressman, this is kind of the Super Bowl for your home state. Every year, you've got thousands of people going there to try and get a good sort of just a piece of investing advice here from Warren Buffett. What are you looking to hear?
Well, obviously, we celebrate and have celebrated the success of Warren Buffett and all of his investors for decades here in Nebraska. Nebraska's home to a lot of top 10, Fortune 500 companies. Today is a celebration of everything that Berkshire Hathaway has been able to do for investors. And what we look for from Warren Buffett is the stability and the common sense leadership that he provides in our markets. Every single year, you take away a couple of real nuggets from Warren Buffett, and he's careful not to share them much along the way throughout the rest of the year. And so we're looking forward to that. And I know that not just Nebraskans, but Americans and investors from across the world are converging on Omaha right now. And you're right, this is the financial services Super Bowl of America right now, and I'm in the middle of it.
Well, Congressman, I'm sure many investors are going to be eagerly awaiting for what Warren Buffett has to say about the recent instability and turmoil that we've seen play out within the regional banks. I'm curious to get your perspective on that turmoil and what you think that landscape looks like for regional banks here going forward.
Well, one of the big strengths to the American financial system is that we have diversity in the types of financial institutions that we have. Obviously, we have thousands of community banks. We have that middle tier, which we're very worried about right now. And then we have the large banks like Bank of America, Wells Fargo. One of the things that we're working on in the Financial Services Committee is what do we need to do when it comes to FDIC insurance? What does the Congress need to do in terms of rules and policies to protect that middle tier? SVB, Signature, obviously First Republic, different situations in the last one. But at the end of the day, we need to protect that middle tier. It provides us the diversity in our financial markets that the European Union doesn't have. In the EU, you just have the big banks, which allows policies like climate change to seep into the markets and to have a disproportionate effect. Here in the United States, we're very focused, and we're very focused under Patrick McHenry's leadership, protecting that middle tier and promoting diversity in our institutions.
You know, investors still certainly trying to process the wild swings we saw in the regional bank stocks this week. There's some concern about short sellers targeting these names, and potentially that was the reason behind the volatility that we saw. You're on the House Financial Services Committee. Would you support a temporary ban on short selling? And do you think something like that is necessary to at least restore the confidence within the financial system?
You know, I'm not ready to go there yet. I think that what we need to do is we need to recognize that investors, depositors need to have confidence in that middle tier. That was the issue that led us down the road with SVB and Signature Bank. We also recognize that we're in an environment now where the wrong tweet or digital information can cause a modern day bank run. Do we need to take some steps? Yes. I'm not convinced exactly what those steps are. I'm still sifting through the Fed's report, and I know as a committee, we've been off this week and we're planning to meet next week and get more information and ultimately chart out a course that protects that middle tier of banks in the United States.
Another thing that's keeping Congress lawmakers very busy is the showdown over the debt ceiling. And I know President Biden planning to meet with congressional leaders, speaking with them next Tuesday. I'm curious just to get your perspective. It doesn't leave much time to get a deal done. Are there any signs that these talks are progressing at all?
Well, if you would have told Americans 60 days ago that a majority of House Republicans could land on a debt ceiling plan, I think a lot of people would have been surprised. The fact that we got 217 votes to put everything together speaks about the unity we have in the House conference right now. The ball is clearly in President Biden's court. It's clearly in the Senate's court. We need them to act in the best interest of our nation. And there's never been a debt ceiling conversation that hasn't included talks about spending cuts. We have to look at both the short term and the long term. And that's our message from the House Financial Services Committee. We're committed to a responsible raise of the debt ceiling, but we also have to look at how we are mortgaging our children's future. And we are looking for, as you know, $4 trillion in cuts over the next 10 years. And that's exactly what we delivered to the Senate. And I know that President Biden got a real wake-up call when it happened. His spending has gotten us into this jam, and now he needs to figure out how we're going to lift this ceiling and work with the House Republicans to make it happen.
Congressman, there are some reports out there that suggest there are a small handful of some of your Republican colleagues that are potentially considering a debt limit increase by a procedure that would essentially bypass House leadership. Where do you stand in that debate? And would you ultimately support a temporary increase in the debt limit to allow for further negotiations?
I think what America's missing right now is that the Republican conference is united behind Speaker Kevin McCarthy's leadership. When I voted for that debt ceiling deal in the House of Representatives, I essentially was voting to empower Speaker Kevin McCarthy to transact this deal on the House's behalf. And I think when you talk to our conference, you will find almost to a one, we are united in our belief that Kevin McCarthy is going to be the one at the negotiating table. Kevin McCarthy, our Speaker, is going to be the one that makes the decision. And this idea that we're somehow fractured is, I don't know where that's coming from. It's probably a rumor that Democrats want to start. That's not what I see when we're in the room. And don't get me wrong, there's a lot of us like myself. I would say almost all of us, we see the value of, we know the importance of a debt ceiling increase when we're facing these problems, but we also know that it has to be paired with cuts. It has to be paired with slowing down our financial spending. And that's why when we talk about negotiating, Speaker Kevin McCarthy is our proxy. He's the one doing it, and we're united behind him.
Well, we will see whether your party and the other side of the aisle is able to reach an agreement here in a timely fashion. Congressman Mike Flood, thanks so much for your time. Have a great time at the conference.
Thank you very much. Appreciate it.
All right, well, coming up, we go inside the wealth of the royal family as Britain gets set to hold its first coronation in more than 70 years. Stay tuned. Britain is holding its first coronation in 70 years. King Charles III will be crowned alongside his Queen consort Camilla at London's Westminster Abbey on Saturday. The affair is expected to be quite expensive, but the celebration is also boosting tourism. The wealth of the crown is complicated topics. Let's break down what we know. King Charles is said to be worth between $745 million to more than $2 billion. That's according to estimates from the Sunday Times Rich List and The Guardian. Now, Buckingham Palace hasn't replied yet to our request for confirmation of these numbers.
And digging deeper into the king's net worth, the first is the Crown Estate. It's a collection of properties, land, wind farms, and retail spaces. These assets are worth around $20 billion, according to the Wall Street Journal. The salary for the monarch today is known as a sovereign grant. Last year, it was more than $106 million.
The next source of the king's wealth is his properties. King Charles inherited Balmoral Castle in Scotland and Sandringham Castle in Norfolk from Queen Elizabeth. Now, each estate is valued between $66 and $79 million. That's according to the Journal. The king also controls the Duchy of Lancaster. Duchies are essentially portfolios of investments, including land and property. The monarch makes money on the annual revenue duchy assets generate. Last year, Queen Elizabeth made nearly $30 million.
And finally, the royal family has additional wealth through generational holdings. Queen Elizabeth left King Charles about 70 horses, thoroughbreds valued at $34 million. The royals have a stamp collection worth at least $126 million, an art collection worth $30 million, and of course jewels valued at nearly $674 million. These estimates are all according to The Guardian.
So while we have plenty of estimates out there on the crown's wealth, we don't truly know the full extent. Let's talk to our next guest about this because she says that it adds to the mystique of the royal family. We want to bring in Julie Montague, Viscountess Hitchingbrook. Viscountess Julie, it's great to see you here. So why do you think that is, just in terms of the unknown when it comes to the wealth of the royal family and the mystique that this really creates around the family?
Well, I think one of the reasons that we're all so, well, many of us are infatuated, if you like, with the royal family is because of this mystique around them. We don't know what their wealth is exactly. You know, you sort of can put a finger in the air and guesstimate, as I've just heard right now. It's never been confirmed. And it is this mystique that makes us want to know more around them and about them. And it's almost as if they're untouchable, but yet they are touchable. And it's this complicated, I think, relationship between the private family, the royal family, and the public. And that's what makes them so interesting and of course, mysterious.
Is it just about the mystique, though? Is it also about perception? I mean, certainly, as you say, the royals are, of course, there's a lot of mystery around them, but they're also of the people. I mean, how much of that plays into sort of the secrecy that exists around their wealth?
Well, up until a couple of years ago, I would say the mystique and the mystery around the royal family was, very well locked up. Yes, they were becoming more, I think, authentic and relatable, and they have been evolving as the modern world evolved. But then we've sort of had a bit of a bombshell over the past couple of years where we've actually, through a book called Spare, a Netflix series of Harry and Meghan, that we have found out more about the royal family than we've ever known before. And so I think what the royal family is still trying to do now is to keep that mystique around them. That is why they do not put out statements when they are splashed across the headlines for some salacious gossip. They still keep quiet, and they will continue to do so. And of course, about their finances, absolutely, they will continue to do so.
Julie, let's talk about the coronation. What should we expect? Who do you know about who has been invited, and what that signals about the future of the royal family?
This coronation is completely different and will be completely different than any coronations in the past. And I'm going to use an example here. You know, I've married into a family that has been invited to every coronation since 1661, the coronation of King Charles II. Our ancestor, Edward Montagu, brought back Charles II from exile in Holland for the Restoration. And every Earl of Sandwich has attended a coronation apart from this year. But what's extraordinary about it, and I think rather wonderful, is we shouldn't be invited. You know, we aren't involved with the crown in the same way that our family and many aristocratic families have been involved in the past. But we have two of our farmers, a wonderful couple, all about regenerative farming. They have been invited to the coronation because of their initiative around regenerative farming. So they will actually be at the coronation. And this is what Charles is doing, which is completely different and wonderful, is that, you know, we have to remember that he has been the heir apparent for 70 years. And within that time, he has really developed a passion and around certain charities and initiative. In fact, over 800 charities and initiatives he has supported over his time as Prince of Wales. And he is now recognizing this by inviting, you know, people within those charities to attend. And so it's going to be completely different from what we saw with the red coronation robes and the coronets of all the hereditary peers in 1953. I think that this is very much more inclusive.
Obviously, there's a lot of excitement around the coronation. You've got a lot of people traveling to the UK. They're not invited. They're just there for the excitement. I mean, how big of an impact are we likely to see when you think about the economy overall? It's just one weekend, but there's got to be a lot of business coming in.
A huge amount. I mean, of course, there's reports that this coronation will cost, you know, 100 million pounds of taxpayer money. But we also have to look at the flip side. You know, we're just coming out of the pandemic, which affected pretty much every country and economy in the world. But also, let's remember, Britain has Brexited, and that has, you know, it's the elephant in the room, but, you know, it's hard to find somebody who won't say that Brexit has affected the economy. And so this coronation will, even though it's saying that it's, you know, going to cost 100 million pounds, the tourism, travel is back. Hospitality businesses, the pubs are filled. We saw the Prince and Princess of Wales yesterday visiting a pub in Soho. You know, there's excitement, and also it's a generation of, I think, younger generation that's also getting excited as well, because they can see the impact that the monarchy has on tourism and the hospitality business as sectors, which both suffered so much during the pandemic.
Yeah. Well, those images we're just showing points to that excitement. A lot of people coming up with creative signs there to celebrate the coronation. Viscountess Julie Montagu, thanks so much for joining us today. Really appreciate it.
Thanks for having me.
Well, coming up, we close out the day and get you set for what to watch next week.
Let's take one more look at where we close the day. And for the week, Dow, S&P, and Nasdaq all closing the day higher, looking at the Dow gains of just about 546 points. For the week, though, a bit of a different story. We did see the Dow and the S&P actually close the week in the red. The Nasdaq was able to just eke out a 5-day gain. You're looking at closing just above the flat line for the week. The Dow closing off just over 1%. Well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in, and make sure to tune in to Monday morning at 11 a.m. Eastern Time. Our own Jennifer Schaumburger will sit down with Chicago Fed President Austin Goolsbee in an exclusive interview. Have a great weekend.